Sammy Saggers.
What an intro. What an intro. I tell you what, I've got to get me one of them. So if you're seeing me, I'm not Andy, and I am a ring in. We've lost Andy, and yes, I am now drinking wine on a Friday with my old bro, Jason, everybody. So I think this is my second appearance on your show. So here I am. What happens on the show? What are we gonna talk about?
Well, we did just wax a little bit of lyrical. Usually we talk about our wine. I think you got the Fugazi wine today, haven't you? And I couldn't find any decent wine. I had to raid my mum's cupboard. I got Gossips, and I think that's about $4 a bottle.
It is. I've got some Gossips in the wine cave. It is about $4 a bottle. It's not bad to I don't know. I think it's cooking wine, but give it a go.
Unfortunately, good wine's usually wasted on me, Sag. So, but I'm sipping away, and it's alcoholic, and it probably get me a little bit tipsy, so we can get wound up about what's in the news. But a bit of a shout out to a few people on both.
Yeah, Alison's joined us. Welcome, Alison, once again, second time today.
Yeah, good to see
Alison.
you.
Alison grew up in the same suburb as me, and we're now connecting the dots.
Is that right? Hunters Hill, or
yep.
There you go.
She's a Hunters Hill lass. So good stock.
Wow. Well, there you go. Well, give us a shout out in the chat, folks. As you can probably tell, that's not Andy Fenton right there. It's Sam Saggers. Andy Fenton's missing, MIA at this point in time.
Anyone seen Andy? Let him know he's due on Facebook right now.
Yeah. He's Sam's warming the seat here, but we might wax a bit of lyrical in a minute, Sam. But folks, I know many of us were going to dial into this one today, and we were going to do a little bit of follow-up on the mentoring subject the other day. G'day, Di. Good to see you. We may still get to do that, but what Sam and I will do at the beginning is we'll go through the process, go through our little structure that we have on Wine and Wisdom. And Sam, just to let you know, usually we do a little bit of what's in the news. We pull a few articles up, and we make some comments on them. And then every now and then there's one or two things Andy and I think people should know, and I'm sure you've got one or two of those up your sleeve as well. And depending on the night, if you've got questions and you're sitting there right now, chuck them in the chat, team, gang.
Well, that's great. That's great.
Sam and I'll circle around.
I'm excited to talk about the news. In fact, the best news I've heard all day is Sydney is open for business. So it's great.
Right?
I think.
So what does that mean specifically, Sam? Is it like everyone's going back, or lockdown's over?
Yeah, look, the traffic's back. It's a great signal. Traffic's a signal of the health of an economy, and it is just great news. I was just about to sneak off actually to see the world, and Jason called me, but no, I was out an hour ago, and everyone is everywhere. Shops are open. People are doing business. Trade is back. And the New South Wales Premier just announced that he is going quarantine-less when it comes to international travel. Yeah, so if you're an international participant in Wine and Wisdom, you can come to Sydney as of November, and as long as you're vaccinated, you do not need to hotel quarantine.
Oh, so, that's a bit of a game changer, to be honest.
That's a game changer. That's people coming back. So students, travelers, great news.
You must have been looking over my shoulder when I was thinking, what will we talk about in the news, Sam? So, but he's pretty aggressive in what he's talking about, and he's rattling the tin here. He's talking about, let's go, everyone. Let's get people into Australia. We need explosive growth, and students as well. Like Australia is a little bit off the pace with the students at the moment. Canada's winning, but I'm sure we'll come back. Maybe let's just talk a little bit about what that might mean. Sam, if we got 2 million people over the next 5 years, plus the students, and or the students as accommodation, what Far out. What would that do to our property market?
Well, you know, I was actually talking about the next phase of property, which is no doubt, you know, probably going to enter the rental phase of the marketplace, where we're going to see some high levels of rental growth. And I think Brand Australia, obviously, you know, throughout the pandemic has been pretty good. I mean, you know, the fact that we've actually have a little bit of care around, you know, how society is governed is quite a good thing, particularly for people in emerging economies. So, you know, without question, what I am seeing at a local level is, you know, shops not being able to operate at full capacity because they're short of staff. I think the whole economy at the moment is you know, most small businesses, which are a big meaty part of the economy, are, you know, short staff. So
Yeah.
I think we're going to need it. I think we're going to need people to come back to our urban centers, and you know, it's going to be great for business. It's going to be great for the property market, and you know, certainly one of the challenges that countries have is an aging population, which creates deflation. When older people, you know, get on, they don't spend as much money. And of course, if more of your society is too old, you know, as you would know from no doubt your parents, my parents, they
Yep.
they don't put their hand in their pocket much.
No, they live on a what I like to say, a cup of tea and a piece of toast a day almost, you know.
Exactly.
Yeah,
So,
yeah.
you know, the real underlying opportunity of obviously migration is continued growth. And
Yeah.
you know, as soon as you start to live in a low rate economy with an aging population, you just get deflation, which thing means obviously, you know, a level of stagnation. So look, it'd be great. You know, I've only been observing this premier for the week he's been going, but he's off with a bang. And you know, I think a lot of people would certainly agree. You know, Australia is built on migration, so no point in stopping it now.
Yeah, it has been for 20 years, right? And you know, we had a negative, you know, local population growth. It was going backwards. We weren't having enough babies for the people dying and getting old, and our tax base was getting low, Sammy. And you know, Australia needs it. And you know, maybe, you know, like right now, just imagine this did occur. 2 million people, even if it's 1 million people, it's still pretty damn fine. And but right now, Sam, we've got sort of backed up demand in the world of real estate pretty significantly in key places right now. Even if we had another 100,000 or 200,000 people over the next year or two, that'd put some significant pressure on the supply system right now.
Yeah, I think the only challenge with that plan of obviously bringing so many people here is where to put them, and that is the real challenge. You know, outside one or two isolated pockets, there is a real problem with you know, stock to eventually rent to people. And some cities now is, you know, bursting at the seams. And certainly Sydney and Melbourne, probably the biggest cities with the most amount of product. You know, they'll fill up first, and probably join the other marketplaces which are in undersupply when it comes to rents, or comes to vacancy rates. So yeah, I would imagine it's going to, you know, 2022 is going to be a quick fill up year, and 2023 and beyond, we will probably be talking about how nutty rents are in cities.
Yeah. Well, I mean, it's kind of overdue for a little bit, to be honest. And I remember, Sam, when you and I first caught up, 2003. You know, actually might have even been earlier than that, because we kicked off PRE in 2003. I think it was like maybe even 2001, 2002. We got into business together. we had that kind of, it was almost like a 8 or 9 year run, wasn't it? Like it was the longest property bull run we'd seen ever.
Yeah,
Yeah.
yeah, yeah. No, absolutely. And that those years, wage growth was pretty
Yeah.
it was happening. I mean, you had
Yeah.
mining boom 1 and 2. You were just off the back of the Olympic Games. You'd just come through a transformation of real estate economics through deregulation of banks, and money was flowing, and
Aussie dollar was up there, wasn't it? It was like it was parity and over American, and yeah.
Yeah. So, we've certainly had periods before where, the rental market can climb quite quickly. I mean, look, in many markets, it's climbing quite quickly now. I've got, I don't know about your portfolio, but one thing that I struggle with is sometimes, and this is, I'm sure what other property investors struggle with. Sometimes long-term tenants ain't cracked up to what they're, to be.
Yeah.
I'm probably down dead set $20,000 per annum in rent because the rental market's moving faster than kind of the good bloke factor of having, a long-term tenant. It's almost like I'd love them all to leave now so I could relet the property in market. I've got a couple in Newcastle, which are about $50 under. I've got a couple in Sydney, one of which is, $200 under. And yeah, I think with where we're starting to see, we'll eventually see a big run on this. It's an interesting thing. I don't know. Sometimes I think, long-term tenants are great, but geez, where the market's at the moment and some of the yields.
And I think you can go to sleep at the helm too sometimes, Sam. I mean, I just checked in on mine. I did a little thing, this morning on Coffee Chats, Canberra, the most expensive rent in the country. And my property in Canberra, it's $80 to $100 off the pace. Like funny you mentioned that this morning.
It can go quick. It can go quick. It's a click of a finger and all of a sudden it's up 50, 60, $70. And it is very much very similar, a rental boom to a property boom. If you snooze, you blink, you procrastinate, all of a sudden that suburb you really wanted to get into no longer exists. And, no different to the rental market. So, yeah, look, I think it would be great. Australia's built on migration. And, certainly I think with the unemployment rate as low as it is, I think there is jobs for many of the, persons skilling into the economy.
Well, I was chatting with our accountant the other day, and there's 1,000 jobs on the east coast of Australia, job ads for auditors. It's maybe not your or my skill set, Sam, but there's 1,000 jobs available for auditors right now and no one in Australia to take them.
Yeah. And look, what's interesting is there's a combination of low skilled work available and high skilled. And obviously Australia has run a skilled migration program since really John Howard was Prime Minister. And, skilling your economy obviously increases your productivity. And, Australia's done a really good job over the years of converting, our economy into a more skills-based place. And, obviously right now, though, it would seem, whether you can wash some dishes or, win the Nobel Peace Prize, we need you.
Yeah, absolutely. Just take a bit of a chance to sort of say a little shout out and hello to a few people. So g'day to Di and Paula, Karen, Michelle, good to see you. Maria, Jace O'Neill, good to see you, mate. Haven't seen you for a little while. And great to have, I know two people that are auditors both have a drinking problem. Jace, there's probably too much pressure and stress on them, mate. Uh, so if you're there lurking around in on the live stream, give us a shout out. Let us know where you're dialing in from and who's there. Sean, good to see you, mate. Great to see you. And Sammy, that sort of ties into a few of these pieces. We've had some insane, just some phenomenal growth in the property market. 28% higher than the value of superannuation, the ASX and commercial property combined. The residential property market in Australia gains $1 trillion in 5 months.
Yeah.
There we go. Got Jared and Graham. Now, Facebook user. There's somebody on there. They must be in the group. And I'd love to say hello to whoever you are. Whoever you are, hello. But let us know who you are, because unfortunately sometimes Facebook hides that one. But Sammy, huge amounts of value added to our marketplace. Average
Mate,
loan size up. Yeah, what's going on?
It's definitely a transformation. Certainly the wealth effect, which we've talked about. The markets quite often, after something that shocks them, it's probably what we've learned over the years, things like the GFC, things like challenges that structurally change the marketplace ultimately lead to the wealth effect.
Yeah.
As we know, governments, a bedrock of Australian economics is actually the housing market, and 60% of jobs are linked to real estate, whether that's, the retailer selling a sofa, Harvey Norman connected to white goods, or, a builder, hammering away at real estate. It's almost too big to fail, but yeah, it's an interesting place, I think, where we've seen so many different elements all converge on the real estate at once.
Yeah.
Low cost money, but also,
yes,
a new, I guess, found love of the great Australian dream, and lots of people tucking into real estate for the first time. That millennial movement into the market has just been outstanding. So
huge. Would you call it, Sam? Would you call it like a once in a lifetime convergence of just crazy shit, right? So, COVID hits and the government throws more money than they've ever thrown at stimulation. Interest rates are the lowest we've ever seen. Supply was stuffed, it's this convergence that kind of like this magic thing, Brisbane wins the Olympics, and
there is just, you're right. It is fairly unparalleled. When the GFC hit, the GFC, the cash rate was really high when the GFC hit. 2007,
yes.
I took out a home loan at 13%.
I remember I got one at 11.
And the great thing the GFC did was almost like stop the inflation, which was just with off the back of the mining boom. It was just wage growth, low unemployment. It was getting tough to borrow money, and if anything, the GFC was quite friendly to people's back pockets, which was good, but we never saw the cash rate fall to where it is today. And I remember back then just thinking, to stimulate an economy, the Reserve can drop the rate, and they did back then. And obviously now we're in a situation where we're going to enjoy low rates for a very long time. And I think you're seeing people's sentiment behind that, the sentiment of the average person who just wants to raise a family in a property, going, you know what, I get it. Rates aren't going anywhere. I trust what's going on, and I'll make the move into the market.
Great.
So,
yeah,
but
great.
you're absolutely right. Like it is an interesting convergence of many things all at once.
All pushing in the right direction. Well, but you got to be in it to win it, Sam. I mean, if you're sitting in the bleachers and commenting from the cheap seats, you're not going to get the advantage or the outcome.
Nah.
What would you think? I sort of said this the other week. Just chatting away. I think, and from what I've seen and chatting with Andy and you and others, this low interest rate thing, it's kind of like you get hooked on it. The country becomes hooked on it. It's the crack cocaine or whatever we want to call it. Maybe it's but it's quite difficult to get off this low cash rate, low interest rate for the country. If everyone in the country now refinances at 2% or 3%, any large increases in interest rates could be significant, significant fundamental issues.
Yeah, well, and I can see David there commenting. I'm from socialist New Zealand. Great to see you, Sam, on the show. I think on this week's podcast, I called the New Zealand government a bunch of socialist Marxist. Even though, look, I do think some of the things that Jacinta does is very good for society, but it's probably fair to say New Zealand is even more expensive than the Australian property market, which is quite mind-blowing in itself. And I think if New Zealand's anything to go by, the greatest risk to property investors is actually government intervention. I think Andy was saying that the other night. I don't think the rate conversation's a bit of a dead one, to be honest with you. It can't go anywhere or do anything absolutely crazy because of the ultimate economic risk to the system. So like you've been saying for a while, mate, I think we're in for a good decade of zombie rates of nothing. And probably a game of musical chairs when it comes to where the government, how the government wants to command the economy. And that's just part of the puzzle, mate. I think that's why, it's good to be coming along to events like this, to the mentoring program, because, creating wealth is just about dealing with pain. And there'll be some pain thrown our way, but I think, at the end of the day, low rates are definitely here to stay, bud.
Yeah, absolutely. I think you and I were having a chuckle the other week. I remember distinctly a conversation you and I had when the average price of a new house cracked $200,000, and you and I thought, "Fuck, it's over." Like the new construction home. Like, yeah, mate, 199, 200. Anything with a one on it works, and we're like, "Oh, the world's ended."
I know. I feel like every 5 years we're like, what? It's gone from 3 to 4. It's gone from 4 to 5. I think, where I'm probably seeing, a good level of opportunity in Australia where people can buy a really affordable property in a very livable suburb. I still finding good value, really 6 to 7. Anything with a 5 in front of it's an absolute bargain. But they're definitely out there. But it's, it's where it at. Wealth is an accumulation strategy. Michelle's said she's watched the first million versus second million. It's so true, Michelle. Like, maybe Jason can show you through that, with his whiteboard. Maybe I can try my whiteboard. I don't know. Will that work?
Give it a whirl. Give it a whirl. I'll switch this around, Sammy. Voila. There you go.
Yeah. So one of the things I think that, property investors kind of don't comprehend is becoming wealthy out of real estate is actually easier at the tail. Because if you think about going out and buying a 500K property, trying to make that $1 million, and this is what I was talking to Michelle about, Jace, that's 100% you need on your money. That's that's quite a distance for wealth to travel. And then, of course, your second million from 1 million to 2 million, that's another 100%. And as you know, Jace, one of the things that you coach so well is the idea of, wants, needs, and dreams. And most people really, if they can get to $2 million worth of real estate, not only from a yield point of view, does that spit out 100K in income on a 5% return, but it's rather like clean air, because as soon as you crack the $2 million playbook to make another $1 million out of your assets, to go from 2 million to 3 million, you don't need 100% to make $1 million. You just need 50%. And then obviously to go from 3 million to 4 million, what's that? 33% or something. Yeah. So what I think a lot of property investors lose sight in is the idea that you need to accumulate your assets in that tough period. And as you know, most people fail at this part.
Yes.
And this is why we're saying the rich get richer, because the rich don't need 100% growth on their money. They need 20% or 10%. And all of a sudden you're putting yourself in a position, obviously, if you can accumulate the assets, your first million's the hardest, second million's pretty damn hard, and then it just gets easier, folks. One of the big, I think, challenges for people is getting past that early phase hurdle, which, and when these booms come along, it certainly helps the cause, but we've got a long way to go for many of the clients, but it does get easier. Is the point?
Yeah, totally, mate. And it's nice, we're now kind of 18 years into coaching people, and we're starting to see, that 15, 18 years of people building their portfolios, ending up with some amazing results, isn't it? These last couple of years, it's just like mind blowing.
I was just catching up with some clients, and I was looking at their portfolio, and it is really good to meet people going into that preservation of wealth stage that have been doing this with us for 20 years. And when you're looking at their portfolio, and newbies will probably feel like, geez, I've got a long way to go. I'm just starting my marathon. But the enlightening thing, I think, is catching up with many of the older clients and just saying, well, you only need 15% growth and you've got another $1 million here, mate.
Exactly.
You don't need property to double. You only need it to double in the beginning. And then after that, it's just, it just keeps working. And I think Nicole said, enlightening. It is enlightening, because this is why you hear the rich are getting richer, because it's easier to make millions at the more assets you have. And for someone getting started, it's a long journey, but hey, we've got the lashes on the back of that journey, and it's worthwhile. It teaches you a lot. And if you are listening and getting started, no problem with that as well.
Absolutely. And you can use some of the lessons that we've found along the way, Sammy, to maybe make it a little less painful. That's part of being in the mentoring program. But there was a question before about off the plan. Jared asked about it, and do you think that those who've got off the plan deals not yet completed are going to see similar gains, with growth, Sam? And we're talking, one of these little bits of news snippets right here is like apartment values, surge to records in more than half the country as well. So apartments are getting some high attention. What would you say to Jared?
Yeah, mate. Well, depends obviously what and where you bought, but one of the things I like to teach around real estate is, particularly with pre-construction or newer real estate, really is sort of two types of new construction. There's low quality new builds, and then there's high quality new builds. What we know, if you buy at the right square meter rate and you're in the high quality new build section of the marketplace, you're actually in one of the most undersupplied quadrants of the market. And again, you would have to say probably of all the new construction being created in Australia, are only around 20%, 1 in 5 properties come to market as a high quality new build. And generally they make people money. So with construction costs sort of starting to deviate with the logistic problems the world has at the moment, certainly the pipeline over the horizon of what I see, as you know, Jace, we spend close to 200,000 a year on data. One of my favorite data engines is Cordell's, which gives me a 3-year horizon of stock into a marketplace. And what I'm seeing is you've got a couple of dynamics at play. One is some land now is not developable because the mathematics doesn't work based on the new construction. So, for example, parts of Southeast Queensland, you can't develop a 1-bedroom apartment for $700,000. It's never been that much before. Yet the DA is for, XYZ 50 apartments, combination of 1s, 2s, and 3s. And mathematically, those sites now are kind of redundant to the marketplace we're in. And of course, what that does is create stock shortages. What I am saying is, again, if it is a fairly, if you did buy and potentially, you're talking pre-COVID or just around 2020, you've probably done really, really well. But it really depends on, again, if it's the right, off the plan, or if it's something that, you just plucked off realestate.com or something like that. It's a broad commentary. But look, I love, urban rebirth off the plan. I think it does great with, high quality new construction at a low square meter rate. Generally, I find it hard not to make money out of that space. It does perform well.
Yeah, well, Jared said, mate, he got in on Victoria and Vine, and we were sort of chatting about that the other day.
Look, I'll give you some directs. Jared, email me, sam@positiverealestate.com.au. I've got I've got some data on that. 1 bedrooms new, basically up the road, starting at 600. 2 bedrooms new up the road, starting at 1 million. And here's the real one. And we've said this for a while, Jace, the 3-bedroom market, undersupplied, most undersupplied dwelling type in Australia, is 3-bedroom apartments. Think about that, right? Think about how many 4-bedroom houses are being built, how many 3-bedroom houses are being built, how many 1 and 2 bedroom apartments, townhouses being built, and then think about how many 3 bedrooms are being built. Not a lot, but obviously comes with a price tag. We had a client buying V&V 1.6 and now up the street 2.6. So, probably up anywhere from sort of 750 to 1 million. Again, they had to spend more, but I think we are seeing that if you can spend more, you're making more in this market. And I had a valuer say to me the other day, which I know you've mentioned, it's now no longer the worst house in the best street. It is actually the best house in the best street that is making the money. Just like your view shot there of wherever that is, looks like Manly or something. But
it looks like a Sydney shot, doesn't it?
Yeah, it could be. I don't know. It could be Balmoral maybe. Or something. Yeah, I don't know. But it's So Jared, shoot me an email, bud. I've got some good data for you. Definitely, money in that one, that's for sure. But that's a great example with what I was talking about. Urban rebirth location, a lot of heritage in the market, great square meter price to begin with. and
Yeah.
high quality new build, not a low quality new build. So yeah, you
ticking all the
can't
boxes.
lose.
Yeah. Well, and Sammy, we talked about this. We've talked about it a few times. You know, now the interest rates, that kind of like a fake stimulus to property values, is kind of found a floor. Okay, what will drive the value? What will drive the rents? It'll be the quality of the product, not the reducing of the interest rate, so someone can actually spend 100 grand more when they didn't really want to. You know what I mean? It was stimulated by interest rates dropping, not by the quality of the property growing $100,000.
Yeah, we've been held hostage to interest rates for a very long time, and this is again something I think, interest rates just another word for competition. The lower the rate, the more the competition. When interest rates go up, people want more cash in their pocket. Now, when interest rates go down, people are happy to have less cash coming in because they can, obviously budget for more growth tomorrow. And I think the fact we're at an equal playing field now, and will be for a long time, that people will absolutely be looking at real estate on its true intrinsic value as to its location, its aspects, its design, as opposed to playing the competition game, which has just been a race of finance and whatever's available on the day. So I'm really looking forward to the next phase of the market, where capital growth is more niche around the assets, in the marketplace. It's going to be an asset choice marketplace rather than a market-driven marketplace, which is, right up my alley, because, I love finding that type of stock.
Mate, flight to quality has been your, catch cry for ages, and it's coming home to roost now in people's pockets. It's been amazing to see that being led, in that sort of space. And we talked about it the other week, Sam, and I you and I talked about bringing this to mentoring as well. Those places where 100 4-bedroom houses being built, kind of bit naff, but maybe if you added a 5-bedroom or a 6-bedroom in there, maybe the valuation would be 20 grand under, but ultimately the outcome in a year, 2 years, 4 years time could be, 50, 80, $100,000 more than the vanilla 4-bed,
Yeah. I think there's always been a conversation piece around price versus value in real estate, and price does not equal value. It never has. And, the reality is sometimes it is actually better to overspend to lock up a great property. I don't know. Would people prefer a discount on a C or D grade property, or would people prefer to pay 20, 30 grand over on an A or B grade property? We ran a poll internally at work. I think it did go on to one of the groups, and most people would prefer to pay more for the right property than pay less for the wrong property. And I think that sums up, the value versus price argument. I don't think it's smart to get D grade assets because they're affordable. And I see that now coaching people transitioning into their retirement space. I've looked at
we were having a chat about that today, weren't we, Sam? People,
I've had two like quite sizable portfolio reviews this week through work, and these are clients that have been doing this 20 years, and multiple assets. One couple, over 10 assets, and sort of 30% of their portfolio they do not want to take into retirement. And lo and behold, it's the 30% is stock which is fundamentally aged, and they can't actually get a cash flow out of it, even though they've reduced debt a lot on the asset. It's just too many capital costs, too many repairs. And, when you think about it, right, like, $400 a week in rent, $1,600 a month. It doesn't take much to obliterate that. A $5,000 plumbing bill,
The
some
deck's got
electrical work.
termites and it rots away. That's 10 grand for a deck. And
yeah, exactly. And so what's been so fascinating with those two clients is the 30% they need to do something about before they retire is not the more modern assets, which they feel very comfortable. They've got, other than, the odd odds and sods, then they're not worried about it, but they are worried about the contingent liability when you don't work of what real estate has with it, because real estate can be an asset, but it can also be a liability. And obviously it's taking contingent liabilities. As soon as you go, all fun and games, I'm not working anymore, then it gets real. Then shit gets real as to how you feel of the real estate. And it's just interesting. It's their words, not mine. I'm just, I obviously, felt compelled to agree with them that for them to go forward to go into a preservation of wealth stage in their life, they probably are better off culling those ones and keeping the more modern ones.
Yeah. And I mean, Sam, you talk about this all the time, the highest and best use of an asset, right? And so if something's old and, not making the most use of the land that's under it, or the building is dilapidated, you're not kind of dollar per value maximizing the outcome of the rent at the end of the day. And, that's it's kind of like it sort of plays into that sort of idea, doesn't it?
Well, I can show the crowd the idea of rental gap theory, which I did the other day, but it's a bit of a repeat. But rental gap theory is just the idea that at some point it is not viable to use to even increase the rent to justify the cost. So what happens in real estate? You've got time and you've got age on a dwelling, and basically what happens is you've got a period there where you start. And if you start with something that's fundamentally very old to begin with, let's say 1975, the year I'm born, today that asset is 46 years. Let's assume, though, that's here and you want to get to retirement, which is 20 years from now. That asset is now 66 years old. In the middle, you've got this kind of concept known as the rental gap. And what you want when you buy a property is you want your rental gap to be very soft, a very soft curve. And the reason a soft curve works, if you start with something modern and you get you get to your preservation years where you're living off income, during that period, you may want to do just a quick rejuvenation, maybe $30,000 inexpensive to bring that property back to life. But what happens down here is real estate can enter a stage where even if you were to, you couldn't renovate it at a cheap enough price to justify doing it. In other words, you might have to spend $200,000 to renovate an asset, but you only get an extra $40 a week in rent. And all of a sudden, what happens is this is what is called disinvestment. In other words, basically the asset has been disinvested to the point where it is no longer possible for it to grow again. And one of the challenges, I think the biggest challenge in real estate is if you buy a property which is destined to be part of the disinvestment space, but you also buy in a neighborhood where other landlords next to you are also not renovating, then all of a sudden the attraction to that market is really lower socioeconomics. is people can least afford it. People who are half a week away from being broke. And, I think one of the biggest challenges for a lot of property investment is disinvestment. I think with the way really society is unfolding, this is one of the biggest red flags to me, is carrying a contingent liability into your retirement, where it's like, well, I'm not going to spend $200,000 on this property. I won't get the rent back if I spend $200,000. So all of a sudden people do nothing. And when people do nothing, real estate just goes backwards and backwards. And this is where you often see the idea of consensus in real estate, and the divergence of rents. The reality is some of the best properties in Australia, Jace, have the lowest returns.
Yeah.
And that is because they're nice, they're designed, they're in good neighborhoods, and they don't yield very well. And what you often see on realestate.com is something might look good on paper, 6-7%, but actually it has never grown. And it's only because it's going down because of disinvestment that the yield looks attractive.
Yeah, that's so true. Yeah.
And in real estate, we call that rent gap theory. It's actually a theory of gentrification, but it's so accurate, so accurate. Check out rent gap theory. But yeah, mate, it's an interesting science, that one for sure. So,
mate, it's always good to see your brain at work, and good to see you got the old tech going there with the old iPad, mate. It's great.
I'm learning, mate. I'm following your zone of genius. I'll be on the mountain bike this weekend. You'll be in the shed tinkering with some tech.
I will be. I was just doing that not so long ago. So yeah, you got me there, mate. Well, we might put a pin in it, Sammy. It's 5 o'clock
no worries.
6 o'clock there.
Thanks, folks, for letting me be the ring in. Thanks, Jace.
Cheers. Mate, great to hang out with you, mate. We didn't drink much wine, but that's okay.
My one's been sitting in the kitchen since lockdown started. I think it's 4 months old. I don't want to drink it, but good show, good yarn. Thanks for tuning in, guys. Jared, send that email. Alison, I'm going to stalk you.
Yep, do it. All right, well, thanks, folks. What we'll do is I'll try and find Fenton. Hopefully nothing untoward's happened to him. And we'll circle around, and we will. I've got 15 questions here from mentoring the other night, which is our $220,000 tax-free income strategy night. We'll circle around on that one and get those questions answered for all of you guys in mentoring. So, but yep, Sammy, thank you. Thank you, folks.
No worries.
Great to see all of you guys there. That's it. Have a good weekend, mate. And same to you, folks.
See ya.
Thanks for coming. Bye-bye.